The types of investment risks. Notice here we've called it market, but it's market risk or investment risk. They are very similar. We've covered these before in the market risk chapter. Volatility risk, the risk that the price will go up and down too much. This is certain investments such as derivatives and particularly options. They are very sensitive to volatility. Liquidity risk is the risk that you're not able to find a buyer in case you want to sell. Currency risk, the value of the investment currency goes down. Basis risk, two positions do not move in the same direction or do not mirror each other. This is most likely going to be questioned in the case of derivatives. Interest rate risk, certain investments such as bonds and derivatives are very sensitive to interest rate movements. Commodity price risk, commodities are sensitive to uncontrollable factors such as weather insects, which will influence their prices. And equity price risk, either the share price will fall or the dividends might not be paid. Simple. Let's move on. Risk diversification, we've covered these again in the previous chapter. We've said there are two types of factors that influence an investment. You've got a direct factor, direct factors, and these are factors that influence a particular company. We call this specific risks, and we gave them another name which was unsystematic risk. And we said there are indirect factors, and these are factors that influence the whole market, otherwise known as market risk or sector risk, and these are systematic. And we said unsystematic because they are specific, they can be managed and mitigated through diversification. That's what this page is all about. And in the previous chapters, we've also mentioned another type of risk called systemic. Systemic risk, this is the risk that the collapse of a single company, of one company, causes the collapse of the entire industry. An example of that was the Lehman Brothers in 2008. Systemic risk can also be called a contagion. Contagion in Arabic means adwa, it means when one falls, the other will fall. Sometimes called the domino effect. In the exam, CISI usually refers to the 2008 financial crisis as an example of a systemic risk. Beta in the previous chapter in market risk, we studied standard deviation, and we said standard deviation is a measurement of risk, is a measurement of volatility. But how do you calculate it? Compared to its average. So how volatile an investment is compared to its previous historical average. So volatility compared to yourself, compared to itself, or compared to its own average. That's standard deviation. Beta is a second measure of risk. It also measures volatility or sensitivity, volatility, but not compared to yourself or to your average, but compared to the market. So if you have a beta of 1, it means that this investment or this fund or this stock moves with the market, has the same volatility, price volatility as the market. A beta of 1.5, it means you are more volatile than the market. You have a higher risk than the market. If the market moves 1%, you will move 1.5%. It means you are 50% higher risk than the market. If you have a 0.7 beta, it means you are less volatile, you move slower than the market. It means that you are less risky than the market. How much less risky? If you are 0.7, you are 30% less risky than the market. Alpha measures excess return, how much more return you have brought than the benchmark. So if the benchmark or the market made 5% this year, but your investment or the fund's investment made 7%, it means that you had an alpha of 2%. This is excess return. You have beaten the market by 2%, and that's alpha. That's positive alpha. Positive alpha is when you have an excess return over the market. Negative alpha is when you have less return than the benchmark or the market. So the market made higher returns than your portfolio. Nobody wants negative alpha. Everybody wants positive alpha. A beta can be positive and negative. So if beta is +1, it means when the market goes up 1%, you go up 1%. A beta of -1, it means you move opposite to the market. If the market goes up 1%, you go down 1%. Moving on. Sharpe ratio. Mr. Sharpe says, do not look just at the return of a portfolio and judge the performance just based on return. Mr. Sharpe says, even if you have two funds, Fund A and Fund B, and Fund A has a return of 5% and Fund B has a return of 7%, it does not mean that Fund B is the better investment. No. Wait and think about risk. How much risk are you taking? When you are investing in these two funds. Mr. Sharpe uses standard deviation as the measurement of risk. In this case, Fund A has a 10% standard deviation, 10% risk. Fund B has a 20% risk. It means that Fund B is double the risk of Fund A. But did Fund B bring you double the return? No. Suddenly, Fund B doesn't look so special anymore. To calculate the Sharpe ratio, what do? We look at the return of the fund, 5%, minus the risk-free. In this case, the risk-free investment treasury bills is 2%. So 5 minus 2, so that's 3%. 3% divided by 10 gives you 0.3. So in this case, it's 5 minus 2 over 10. Return of the portfolio minus the risk-free, 5 minus 2 over the standard deviation, 10. For Fund A, the answer was 0.3. For Fund B, the answer was 0.25. The higher Sharpe ratio is the better investment. So in this case, even though Fund A has a lower return, Fund A is the better investment compared or adjusted for its risk. Moving on. The information ratio is another risk adjustment return. If you want to study this, how is it calculated? You're not going to get numbers in the exam. You will not need to use a calculator for the purpose of the calculation of the information ratio. But you do need to know what is the information ratio. Simply put, the information ratio measures a portfolio or a fund, a portfolio manager's skill. And is he able to consistently, that means over and over again, to consistently generate excess returns? Is he able to consistently beat the benchmark? If he can only beat the benchmark 1 year, doesn't mean he has skill. That's luck. But if he is consistently beating the benchmark, then this fund manager has skill. How do we calculate it? The mean, that means the average of his excess returns divided by the standard deviation of the benchmark's excess returns. That's how it's calculated. But you are more likely to be questioned on what does the information ratio tell you. It tells you, it gives you an idea about the portfolio's manager's skills. How? By calculating how he consistently generates, whether or not he consistently generates excess returns. Illiquid assets. The two most famous asset classes which are illiquid are private equity and property. Private equity is when you invest in private companies. These are not listed. So you buy equity, you invest in growing companies privately. Why is this illiquid? Because you don't exit quickly. You invest usually for 5 to 7 years. That means the investment is illiquid. It's not like public companies that you can easily sell your shares in the market. The other illiquid asset is property. If you've done the ICWM qualification, you know that property is an illiquid asset. It's difficult to sell property, especially in downturn. When you are investing in property, you can either invest directly in the property, that means buy the property directly, or invest indirectly in the property, that means invest through a fund. Most famous funds are REITs. REITs are real estate investment trusts. These are funds which are listed on the stock exchange. You buy a share, that share entitles you to part of the property. These are listed, transparent property investment vehicles. Returns from REITs are taxed in the same way as direct property investment. One thing you need to know is, for the purpose of this exam, is that REITs reduce the liquidity risk of property, because REITs can be easily bought and sold. They are shares in the market. REITs reduce the liquidity risk of property, but they introduce a new risk. Since they are listed on the stock exchange, the share price of a REIT goes up and down more frequently. So REITs have price risk, price volatility risk. Normal property don't have price volatility. They either go up for a long term or they go down for a long term. They don't fluctuate too much every day, whereas REITs fluctuate a lot every day because they are listed and they are shares, so they are traded easily. What is an investment mandate? A fund's mandate is the fund requirements. What is the fund manager required to do to invest? Usually fund managers are not completely free to choose what to invest in. Usually the fund sponsor has a mandate that says, okay, this fund is going to invest in equities, that means in stocks only, and in the UAE. And that's it. That's an example of what the mandate tells the fund manager. That means the fund manager cannot invest in bonds, cannot invest in gold. Even if the bond and the gold market are bringing higher returns, he can't. He can't invest in equities in the US, for example. He cannot do that because the mandate was very clear. You have to follow the mandate. Invest in equities in the UAE. So what is the mandate? The mandate clearly defines what the fund or the portfolio is going to invest in. For example, this fund is going to generate income, or we're looking for growth, not for income. Specified geographical regions. For example, we are only going to invest in the UAE. Sectors, we are only going to invest in the banking sector in the UAE. What type of equities, asset class? We are only going to invest in equities, for example, and so forth. Shall we be leveraged? Shall we use any debt? Are we allowed to short sell? What index, what benchmark are we going to compare ourselves to? The items that are included in the mandate sometimes come in the exam. For example, which of the following is part of a fund's mandate? And finally, we end the chapter with strategies for portfolio construction. Active versus passive. Easy. Passive means tracking an index. That means you do not try to beat the market. You just try to move with the market. Whereas active means you try to beat the market. You try to beat the index. You do not track the index. You try to beat it. We've looked at the difference between systematic and unsystematic risks. Non-systematic or unsystematic can be diversified, because unsystematic is limited to one company, whereas systematic is market risk. Optimization refers to maximizing the risk-reward trade-off. Pretty clear. Portfolio hedging, we've studied that again in the market risk. Market and investment risk are interlinked. Portfolio hedging is taking offsetting positions to reduce your market risk through derivatives. But don't forget, hedging creates a new type of risk, which is credit risk. Short selling, one way to hedge is through short selling. If you are long in one portfolio, you can go short so that you can reduce any potential adverse market movements. And what is risk transfer? In chapter 1, you studied risk transfer as insurance, letting insurance pay for the risk. Now, keep in mind that here risk transfer is equals to insurance and outsourcing, in case you remember. If you remember from the market risk chapter, we studied credit default swaps. Some of these derivatives, the credit default swaps, can be used as an insurance. You pay a premium, and in case the bond defaults, you are compensated on your capital. So because CDS's credit default swaps act as insurance, CDS's can be considered as a risk transfer strategy. So that's all for chapter 6. We'll see you in chapter 7.